Okay, continuing the topic of business ownership. So now we're going to be looking at usually larger companies, the limited companies. So we've just had sole traders and partnerships, unlimited liability. We're now moving into private limited and public limited companies. The biggest difference with these, and the last video I made, the finances of these companies are separate from the finances of the owners. What this means is that as an investor, I put my money into the company, and if the business was to go bankrupt, the finances of the business are their own, and they cannot take my personal finances. So sometimes you'll hear the phrase, owners can only lose what they invested. What that means is that actually I put money into the company, that belongs there now. If the business fails, then I've lost that. They can't come chase me for more. So that's why I can only lose what I put into the company. So a private limited company is called an LTD. That's the initialism. A limited liability company whose shares are sold privately to family and friends. I may want to add there, and business acquaintances. It's not always family and friends, but it's getting the message across that they're not being given to anybody. Whoever owns the company is deciding which new owners are coming in. You have to know them from somewhere. I mean, sometimes they can be business acquaintances, but fine, you've been introduced to them and you make the decision to incorporate them into the company and you'll sell them shares. So both these companies have shareholders. So advantage being a private limited company, you can now raise finance through share capital. By inviting new shareholders in, you're giving them a share in company, a percentage of ownership of your company, and they are giving you money. Yeah, well, not you, but they're buying it off the previous owner. So they're giving the company money, and they now own a percentage of it. Okay, and it's a great way to raise money. Let's say we want to expand. We invite more owners into the company. We can then use that money to expand. It has limited liability. The owners can only ever lose what they invested. Control over ownership. Okay, so this is contrast with public limited company. We have control over the ownership. This is the part about deciding who becomes shareholders. Okay, disadvantage of a private limited company. You have to fill out two documents that I want you to remember: Memorandum of Association and Articles of Association. These are documentation that goes off to Companies House, the government's organisation that keeps records of all the company's data, and essentially filling those things in is what gives us this limited status and differentiates them from the sole trader and the partnership, which are really quick to set up. The other thing is annual reports must be produced. So you have to produce financial reports, and annual report, which also goes to Companies House, and that goes every year. So there can also be added expense of doing that. Okay, because you're probably going to employ accountants and things and specialists to produce maybe both of these documents. In which case, I talked about a mobile hairdresser maybe wanting to be a sole trader because they didn't want to maybe go through this process here. Okay, public limited company, how does this differ then? So these are called PLCs. And these are usually huge companies. The whole point about them is that their shares are sold on the stock market. They're a limited liability company whose shares are sold on the stock exchange. Huge amounts of finance can be raised through share capital. Just like before, we can sell shares, and people can buy into the company, and it can actually raise huge amounts of money for huge expansions. When a company converts from a private limited company to a public limited company, we'd actually call that floating on the stock exchange. So they can actually become a public limited company as well. And when that happens, there's often a lot of publicity surrounding it. So like Facebook, when that decided to become a public limited company, it was in all the newspapers, everybody's talking about it, and actually it's not a bad promotional method. Limited liability, again, the owners can only ever lose what they invested. If I was to buy some shares of a big organisation on the stock exchange, I send my money over, I receive my deeds, my shares that I own that percentage of that company. If the company was to go bankrupt, I will lose that money that I've bought the shares, potentially, or some of it, most of it, all of it, and then, but I won't lose any more, okay? And that's limited liability. That's why it's an advantage. It's much more secure. Disadvantage of being a public limited company: slow setup for the same reasons as before. Annual reports and financial reports are public. Not only are they produced and submitted to Companies House, but they're actually available so competitors can see them. And then you could start analysing that by thinking about, well, if competitors can see your financial reports, potentially that could affect their strategy. Maybe a predatory pricing strategy, where they're going to try and gain market share over a temporary period of time. So that is definitely definitely a disadvantage that a company needs to consider before going public. They're also difficult to control for two reasons. Divorce of ownership, okay, which means divorce of ownership and control is the full term, which is where essentially it's being owned by shareholders, individuals who have very little influence over the running of the company. So there's a gap between the decision makers, the directors of the company, and the owners. And the decision makers may not be making the right decisions for the owners or following the right objective. They may be satisfying their own objectives and trying to reward themselves somehow because they're actually managing thousands of people's company for them. The other thing is difficult to control. If an individual was to accumulate a certain proportion of shares in a company, they can actually force a takeover of that company. And then not only that, it's losing sight of the objectives. It's if we think about going back to Mark Zuckerberg floating Facebook on the stock exchange, let's imagine that Mark Zuckerberg had an idea of what he wanted it to be. Often with PLCs, they lose that. They lose that objective, that idea, that original goal, because now they're being owned by anybody who's bought through the stock exchange, and their objective will definitely be to increase their wealth, which conflicts with what it originally started for. Okay, so evaluations to here then. Should a company change to one of these? Should they be one of these? Any evaluation of business ownership you need to consider depends on the size of the business, the finance needed, and objectives of the entrepreneur. So when we're saying it can raise huge amounts of finance, is huge amounts of finance needed? Are the objectives maybe ethical, in which case you need to keep control of it? So we need to really say it depends on the size, the finance needed, and the objectives. If you explored that point there, you'd be able to question whether a business from a case study had chosen the right form of ownership.